Welcome to Compound Insights, a podcast by CFA Society New York. I'm your host, Rob Rowan. Today we are speaking with someone who is responsible for the marketing of many value firms, Hedda Nadler. But first I'd like to thank Hedda for being a tireless contributor to the June 20 and 21st Ben Graham 10th Annual Conference. If you like what she has to say on this podcast, you will likely want to sign yourself up for it at our website. So, Hedda, thank you for being here with us.
Thank you, Rob.
I'd like to start by asking you to talk about your firm, which has a massive amount of longevity and has done, really stable more than most during your time. So can you talk about how you kind of got from there to here, please?
Okay. We founded the firm in early 1980 when most mutual funds and money managers just did not do any marketing at that point because many of the mutual funds were offered by brokerage firms and or insurance companies. And we ended up having a little bit of an expertise in marketing what was then called no-load mutual funds. Yeah. And at this juncture, virtually all of them are.
Right.
So we had the privilege of starting with Mutual Series Co-op, which was at that time Mutual Shares Co-op, and this was run by Max Heine and Michael Price, two legends in the business. And we actually held on to that account until Michael sold to Franklin Templeton in the late 90s.
Okay.
So it was an interesting time to promote mutual funds. And of course, life was simpler then in terms of the different strategies. It was more like value, income, bond funds. And sometimes a balanced fund, and there was no alphabet shares, there were no ETFs, there were no index funds, et cetera. Right. At any rate, what we did was very basic public relations, which we still do today to a great degree, which is to try to get the name of the firm and the story about the firm or the fund in press. The press situation has clearly changed. Now we have podcasts, we have mostly online media, we have different presentations by different groups where we try to get our clients speaking dates, such as the CFA Society of New York. And it's virtually any forum, if you will, where the client can address its target audience or audiences.
This is what is fascinating to me is you've been through a massive amount of change in the types of products, the regulation. Journalists went from, you could be a print journalist for a while, but not anymore. Now you have to be the triple threat. You have to sing, dance, and act. And, it's a wild amount of change. So let's go back for a second, because this is the house that value built to some degree or another. How do you make a case for value investing today?
To us, value investing is timeless. Even though the scenes around us, the markets, the products, if you will, the players have significant changes that have occurred. But basic value investing, mostly stock picking at a reasonable price or a bargain price, where you're trying to make sure that clients and or shareholders don't lose any capital over the long term. It's something that we have seen is here to stay. My firm was founded over 40 years ago, and value investing has evolved over the years. Maybe there's different stocks that they look at, but the basic trying to find a stock selling at below book value with little or no debt is still a timeless strategy, and one that resonates with a lot of audiences, whether it's advisors, institutions, the retail market. So it's a good strategy that's timeless.
And that's one of the things that I think is interesting about value is there are more. If we were doing this podcast a year ago, there would be a lot less product to choose from. But the last year has really done a number on it. So,
right.
This is one of the things that I think is interesting. But I wonder how much of you talk about active stock picking there. I wonder, do you think that there has been a certain amount of overplaying of index funds, or do you think we're at a good balance point now, or do you think it's going to shift back? Or
I think there's too much emphasis on expenses. And a mutual fund, an active value mutual fund that has high expenses is maybe 1.9%.
Right.
Clearly, an index fund is going to have, half of that or less. But the realities are it's still only a little more than a 1% difference. And if you're mirroring an index that has, let's say, average or lackluster performance, you may be better off with an actively managed value fund with a, quote, higher expense ratio, but who knocks the cover off the ball occasionally. As Max Heine used to say, value investors over a 10-year period, they'd have 1 year where they hit a home run, and they have 1 year where they're in the basement. And the other 8 years are where they, according to him, average around 8%. I'm good with 8% a year.
Yeah. So,
compounding.
Right. I was going to say it compounds to double after about 7 of those 8, right? So, yeah.
Exactly.
Yeah. It's fascinating to me that, we have these sort of fads in the investment management world. And I've often wondered also is, and I wonder what you think about this, one of the reasons investors get hung up on fees is because they're easier to understand than many of the other metrics that are applied to portfolios.
Right. And I think it's a storyline that, experts like Morningstar and other mutual fund organizations, if you will, Vanguard clearly, right? I mean, a little self-serving. They push that message out. And honestly, Rob, it's a good message for an average investor with, let's say, a small portfolio. They can actually do well with index funds, a little assortment of index funds, and not have to worry about, switching, rebalancing, or let's just put the money in and let it ride.
Right. And could you put a little parameter around what you mean by small?
Excuse me?
Could you put a parameter around what you mean by small? Are we talking
a small investor?
Yeah.
Well, I guess it's in today's world, I'm thinking of someone, even a starting investor like a millennial who has, $10,000, $5,000
right, in their first
to
401k.
invest. Start there, but let it ride. Hopefully it's money that you don't, quote, need, and as it accumulates, you may need to take some money out, but it's going to grow and compound nicely if you leave it alone. And you want then to buy a house or a car or take a lavish vacation or something,
Yeah. Well, so fascinating. I guess one of the other things I think is interesting about the work you do is most of the value funds are small, and boy, are there some big ones out there now, getting bigger by the day as the banks fail. So, how do you help them to position themselves in that dichotomy?
Right. What we try to do is to understand how that fund or manager differentiates himself or herself. So a lot of even boutique value managers or funds who come to us and may have $500 million in total under management with an SMA or a mutual fund, they say, well, how can we compete with Fidelity? And I said, you can't. They're not your competitor.
Okay.
Who is your competitor? Someone who also has $500 million in assets, right? And how are they garnering assets? How are they attracting shareholders or clients? And then we try to position the message accordingly. We try to find out if there's a unique sauce to the value strategy. We represent a lot of value managers, and there's very little overlap among all the portfolios in terms of the specific stocks.
Okay.
So also if they get to where they're small cap managers or mid cap managers, there it's an art almost to the stock picking. And then if you take it one other level where they're not diversified and they're focused portfolios, 20, 30 stocks, very often there's absolutely no duplication amongst the portfolios. So it's fascinating.
Yeah, there's a fascinating slide as you go down cap to the small ones where information gets a lot harder to get. Further to that, what types of things do you tell them to articulate to people? What are their hot button issues, that the reasons they're there? What do they tell them?
We think that it's more about temperament and emotion than about the facts of what the client might think about the market, the debt ceiling, interest rates, politics, etc. Because you can get plenty of that input from experts, all over the press and TV and whatever. So we're always saying appeal to the emotion of the client, the prospective client, the shareholder. If you get a call where someone's worried, you don't want to say, well, there's nothing to worry about. The market is strong.
Right.
You need to say, we hear what you're saying. And that's why we've positioned the portfolio in such a way where it's defensive in these turbulent times. So you can rest easy. You could sleep at night knowing we have your best interests at heart and that we're taking care of you and your money. And to be accessible, clearly, if there's some turmoil that occurs or a black swan, you want to be available by phone. You want to have someone respond to emails. You don't want it to go to an 800 number where they have to go through a long menu and then sit on hold for 20 minutes. That's really going to add to the angst that people are feeling, and that's counter to what you're trying to accomplish. So it's more like someone feels like they're part of your family, that you really care about them and their money.
Interesting. So you're leaning into an investor's anxiety about just the uncertainty of the future.
Correct.
Interesting.
Correct. A lot of times people say, I'm scared. I saw the market went down 300 points. It'll come back. That's not going to work with clients and shareholders.
Oh, really? That's it's a little opposite of what I say, which is usually well, we don't need the money today. So,
right. Right.
And I guess we should leave it there because we do want to leave people with some ideas about what they should, reasons they should go to the June 20th and 21st Ben Graham event. So, Hedda, thank you very much for being here.
Oh, you're quite welcome. It was a pleasure.
And thank you to everyone who listened to the podcast. If you'd like to register for that event I just mentioned, once again, it's the June 20th and 21st Ben Graham 10th annual event, which you can register for on our website at cfany.org. Until next time, I'm your host of podcast, Rob Rowan.